A kitchen table, a few coins stacked in a small, careful pile, a bill from the electric company sitting unopened beside them because opening it wouldn't change what it said, an almost empty pantry shelf behind a woman standing perfectly still, waiting for a sound she hasn't heard in 3 weeks, her husband's footsteps coming home with news of work. What happened to this family? Nothing sudden, nothing dramatic enough to make a headline of its own, just the slow, quiet collapse of an entire economy arriving one missed paycheck at a time, until an ordinary household found itself asking questions it had never needed to ask before. How do you survive when income simply disappears? What do you do with the little money that's still coming in? And why, nearly a century later, would any of this still matter to a family managing money in 2026? By the end of this video, you'll understand the one financial principle that made every single dollar count, and why so many of us have quietly forgotten it. If you enjoyed discovering what ordinary American families understood about money before modern banking and spending apps did the thinking for them, subscribe, because this story gets surprisingly relevant. The Great Depression began in 1929 and stretched through most of the 1930s, a decade defined by bank failures, mass unemployment, and a level of financial uncertainty that touched nearly every household in the country, regardless of where they lived or what they did for work. Wages fell. Savings, in many cases, simply vanished when local banks closed their doors, sometimes overnight, taking a family's entire financial cushion with them. Millions of Americans found themselves without steady income for months or years at a stretch, and the certainty that had once seemed ordinary, that a paycheck would arrive next week the same as it had the week before, could no longer be assumed by anyone. Imagine a family in 1932, an ordinary household in a small American town, not wealthy, not desperate beyond hope, simply caught in the middle of something enormous and largely out of their control. A father who still had work, for now, though his hours had been cut, and no one could say for how much longer. A mother managing the household day to day, stretching whatever came through the door. 2 or 3 children who understood, without being told directly, that this year looked different from the one before it. A modest rented home, a grocery bill that had to be planned around, not simply paid. This family didn't need to become wealthy to get through the month. They only needed to make it to the next one. Before the crisis, a family like this could reasonably assume next week's income the same way they assumed the sun would rise. That assumption quietly disappeared for millions of households once the Depression took hold, and something had to replace it. Job security evaporated for many workers almost overnight. Savings that had taken years to build were sometimes gone within days when a local bank failed. And what took root in its place in many households under this kind of pressure was a much more deliberate relationship with every single dollar that came through the door. A dollar meant for the grocer wasn't the same as a dollar meant for rent, and neither of those was available for anything resembling an impulse. Many households began mentally, sometimes literally, dividing their money the moment it arrived, assigning each portion a specific purpose before it had the chance to disappear into something less essential. The housewife managing that household often became the one holding this entire structure together in her head, deciding in advance exactly what each dollar was for, long before it ever left her hand. But knowing where every dollar belonged was only useful if there was something left over to actually stretch. What happened when the money simply wasn't enough to cover everything a family needed that week? For many households, the answer began in the same place it always had, the kitchen. The pantry, during this period, became something closer to a financial instrument than a simple food shelf. For many families managing tight budgets throughout the 1930s, cooking at home wasn't a preference, it was close to the only option available. And it demanded a kind of planning that modern grocery shopping rarely requires. Picture the housewife opening that pantry door, looking over what remained from the week before, and starting from there rather than from a wish list. She wasn't asking what she felt like eating that evening. She was asking what could be made from what was already sitting on the shelf, a question that shaped nearly every meal in households under real financial pressure. Leftovers, in this context, weren't an afterthought. They were often the entire plan. A modest cut of meat might appear at dinner on Sunday, then reappear, transformed, in a soup or a hash by Tuesday, stretched deliberately across several meals rather than consumed in one sitting. Seasonal produce, cheaper and more available at certain times of year, shaped what appeared on the table far more than personal preference did. Many families who had any access to land, even a small yard, grew at least some of their own vegetables, and preserving that food through canning, drying, or simple root cellar storage extended a single harvest across months instead of weeks. Waste in this environment wasn't treated as a minor inconvenience. In a household with almost no financial cushion, throwing away food that could still be eaten represented a cost the family often couldn't reasonably absorb. This kind of planning required a different relationship to the grocer, too. In many communities, a family with a good relationship built over years might be extended a small amount of credit during an especially hard week, a practice that depended entirely on trust between neighbors rather than any formal system. That trust wasn't guaranteed and it wasn't available to everyone equally, but where it existed, it often meant the difference between a thin week and a genuinely empty pantry. Bartering, too, played a real role for some households, trading eggs for flour, or a few hours of labor for a portion of someone else's harvest, an informal economy that ran quietly underneath the cash economy for families who had very little cash left to spend at all. None of this means every family in 2026 wastes food carelessly, and it would be unfair to suggest otherwise. Abundance simply changes behavior, the way scarcity did for an earlier generation. When groceries are relatively accessible and a missed meal plan doesn't threaten the week ahead, the pressure to stretch every ingredient naturally loosens. That isn't a moral failing, it's simply a different set of circumstances producing a different set of habits, shaped as much by what's available as by what anyone actually values. But food wasn't the only thing families under pressure during the Depression learned to stretch. What happened when something in the house broke and there was no room in the budget to simply replace it? For many households throughout the 1930s, a broken item didn't automatically mean a trip to buy a new one. It meant a closer look first. Clothing that had torn or thinned at the seams was mended rather than discarded, often more than once over its lifetime. Shoes with a worn sole went to a local cobbler when the family could spare the small repair cost, because that cost was reliably lower than an entirely new pair. Furniture with a loose joint or a wobbling leg got tightened and reinforced at home rather than replaced. Kitchen equipment, household tools, even simple containers, all of it was expected to serve its purpose considerably longer than it might today, because for a household with almost no margin for error, a purchase didn't really end the moment an item came through the front door. The family still had to make it last. This wasn't unique to the Depression era in any absolute sense, But the financial pressure of the 1930s made durability a necessity rather than simply a preference. Modern manufacturing has, in many respects, made replacement both easier and often genuinely cheaper than repair, which changes the calculation considerably from what a household in 1932 would have faced. That isn't a flaw in modern life so much as a different set of trade-offs. But there's a financial logic worth remembering regardless of the era. When a household spends less money replacing things that could reasonably have been repaired, more of that same income remains available for the necessities that can't be avoided, a principle that mattered just as much when prices were considerably lower as it does now, when inflation has made nearly everything cost more than it once did. But there was another kind of expense that could undo months of careful saving in a single afternoon, and it had very little to do with what broke around the house. Debt during the Great Depression carried a weight that's difficult to fully appreciate from the comfort of steady modern banking. It would be inaccurate to claim that every family during this period avoided debt entirely, because many households did borrow, from relatives, from local shopkeepers willing to extend credit, from whatever source was available when a genuine emergency arrived. But for households under severe financial pressure, debt felt considerably more dangerous than it might feel today, precisely because future income could no longer be assumed. Borrowing against a paycheck that might not actually arrive next month was a real and serious risk, not a hypothetical one, and many families approached that risk with real caution, weighing an unexpected medical cost, a housing payment, or a sudden loss of work against the very real possibility that repayment might become impossible. There is a distinction worth sitting with here, one that connects directly to how many households approach money today. It's the difference between asking, "Can I afford the payment?" and asking, "Can I afford the purchase?" A family in 1932 facing a genuine emergency had little choice but to ask the second question, because the full cost of anything borrowed had to be repaid from an income that could vanish without warning. Modern recurring payments, subscriptions, financing plans, buy now, pay later arrangements, automatic monthly charges have in many cases shifted that question toward the first one instead. A payment that fits comfortably into a monthly budget can feel manageable even when the underlying purchase, added up in full, represents a considerably larger financial commitment than it initially appears to be. This isn't a modern finance lecture so much as an echo of something households under real pressure in the 1930s understood instinctively, because they had no other choice but to understand it. An emergency reserve, where a family managed to build one at all, rarely amounted to much in raw dollar terms, sometimes only a few dollars set aside in a jar or tucked into a mattress rather than trusted to a bank that might not still be open the following month. But the psychological value of that small reserve often mattered as much as the money itself. It represented one version of the future that wasn't entirely at the mercy of whatever happened next, a small buffer against a world that had already proven, repeatedly, how quickly things could change without warning. The Depression did not teach families how to become rich. It taught them something much more basic, how quickly financial security could disappear entirely. And that's where this story becomes genuinely uncomfortable for us today, because modern households can earn considerably more money in real terms than a family in 1932 ever did, and many of them still end up feeling just as financially exposed. Why would that be true? Part of the answer lies in how spending itself has changed, not just in amount, but in visibility. A dollar spent in 1932 was, in the most literal sense, something you could see leave your hand. Physical cash, counted out at a store counter or set aside in a labeled envelope at home, created a kind of built-in friction around spending that simply doesn't exist in the same way today. Digital transactions have removed much of that friction entirely. A one-time purchase in that era stayed a one-time purchase, while today a recurring expense can quietly renew itself month after month without requiring a single fresh decision from anyone. Repairing an item required visible effort and a specific choice, while replacing one today often takes no more than a few taps on a screen. Planning a week's meals around what the pantry already held has, for many households, given way to convenience spending that solves the same problem instantly but rarely as cheaply. Delayed gratification, once a practical necessity for households with almost no margin for error, has been replaced for many people by the simple ease of instant purchasing. None of this is really about blaming technology itself. Technology didn't create carelessness. It changed the friction surrounding every financial decision, and friction, it turns out, was doing more work in household budgets than most of us ever gave it credit for. A household in 1932 physically ran out of cash the moment the envelope was empty, and that emptiness was impossible to ignore. A modern household can, in many cases, keep spending well past the point where an envelope would have already emptied, simply because the signal that used to arrive instantly, an empty hand, a light purse, now arrives later, if it arrives clearly at all. If that family from 1932 could somehow see a modern household's full list of recurring monthly payments, subscriptions, financing charges, automatic renewals stacked one after another, what would surprise them most likely wouldn't be the total amount of money involved. It would be how little friction stood between that money and the moment it left the house, and how few deliberate decisions were actually required to keep it flowing out month after month without anyone needing to consciously choose it again after the very first time. So what did the Depression actually get right, stripped of all its very real hardship? The lesson buried inside this entire story was never simply be poor, and it would be a disservice to an entire generation to reduce it to something that thin. The real lesson was closer to know what matters, a principle that emerged naturally from households with no other choice but to practice it. Every dollar had a job before it was ever spent. Food wasn't casually wasted because waste had a cost the household could genuinely feel. Belongings were maintained rather than replaced at the first sign of wear because maintenance was consistently cheaper than starting over. Savings, wherever a family could manage to build any, created a small but genuinely meaningful buffer against the unpredictable. Debt came with real obligations attached to it, obligations that couldn't be assumed away by hoping next month's income would simply appear. Convenience, in the modern sense we understand it now, had a cost that many households of that era simply couldn't afford to pay. And income itself was never confused with actual wealth, because a paycheck that could disappear without warning wasn't the same thing as genuine financial security. None of this means we should romanticize what these families actually lived through, and it would be a disservice to suggest otherwise. The Great Depression brought real hunger to millions of American households. It brought unemployment on a scale the country had never experienced before, and widespread homelessness that displaced families across the entire nation. Bank failures wiped out savings that families had spent years building, sometimes overnight, with no warning and no recourse. Severe poverty touched communities in every region of the country, and the psychological toll of that sustained uncertainty followed many people for the rest of their lives, long after the economy itself eventually recovered. This wasn't a simpler, gentler way of living that we've somehow lost access to. It was, for a great many families, a genuinely painful chapter in American history, and it deserves to be remembered honestly rather than nostalgically. We don't need to recreate the hardship in order to recover the wisdom that came out of it. Let's return one final time to that kitchen table, the handwritten ledger if a family happened to keep one, the pantry carefully managed rather than casually stocked, the mended clothing worn considerably longer than it might be today, the money divided with real intention the moment it entered the house, the small emergency reserve wherever a household had managed to build one at all. What would happen if a modern household treated every dollar with that same level of intention, not out of necessity the way that family in 1932 was forced to, but simply as a choice made deliberately rather than under pressure? The biggest lesson from the Great Depression was never really about making less money. It was about becoming genuinely aware of where money goes once it arrives, a kind of awareness that scarcity forced onto an entire generation and that modern abundance has made considerably easier to lose track of without anyone quite noticing. The Great Depression did not teach people how to live without money. It taught them how to live with purpose when money was scarce, and that distinction matters considerably more than it might seem to at first. The world has changed enormously since the 1930s. Our incomes are different, our technology is different, our homes, our stores, our entire relationship with spending look almost nothing like they did for that family standing in a quiet kitchen in 1932, waiting for footsteps that might carry good news or might carry none at all. But the basic question underneath it all hasn't changed nearly as much as everything surrounding it has. When money comes into the house, does it already have a purpose, or does it simply wait to see what happens to it next? That family never got to choose the circumstances that forced them to answer that question so carefully. They didn't choose the bank failures, the lost wages, or the uncertainty that followed them into nearly every decision they made. Most of us today, by contrast, still have a genuine choice available to us. The choice to bring that same intention into our own kitchens voluntarily, long before any crisis ever forces our hand. That may be the most meaningful difference of all between their kitchen table and ours. What is one money habit from your parents or grandparents that you think modern families should bring back? Tell us in the comments. We'd genuinely love to hear it. And subscribe for more forgotten stories about the households that came before us.